The late 1990s witnessed an unprecedented technological revolution, a time when the world was on the brink of a digital transformation. The internet, once a niche tool for academics and researchers, was rapidly entering homes and businesses around the world. It was a period of rapid adoption, with people eager to explore the possibilities of this new technology. This period, etched in history as the dot-com bubble, was a time of immense innovation, unbridled optimism, and ultimately, a spectacular crash. The excitement was palpable, but so was the risk. This essay delves into the factors that fueled this extraordinary bubble, the market psychology that drove it, and the enduring lessons it offers for investors and entrepreneurs alike. Understanding these elements is crucial for navigating future technological booms. The allure of the internet was undeniable. It was a new frontier that promised endless opportunities and a chance to be part of something revolutionary. It promised to democratize information, connect people across continents, and revolutionize the way we live, work, and interact with the world. The potential seemed limitless. Investors, both seasoned and novice, were captivated by the seemingly limitless potential of this new digital frontier. The stock market was buzzing with activity, driven by the promise of high returns. Companies with a.com suffix, regardless of their underlying business model or profitability, became magnets for capital. The frenzy was unprecedented, with valuations soaring to unimaginable heights. The dot-com bubble was born, a phenomenon that would leave a lasting impact on the world of technology and finance. One of the primary catalysts of the dot-com bubble was the readily available venture capital, which flowed freely into the market. Venture capitalists, eager to capitalize on the next big thing, poured billions of dollars into internet startups, often without thorough due diligence. Many of these startups had unproven business models, relying on vague promises of future profitability and ambitious growth projections. The traditional metrics of assessing a company's worth, such as earnings and dividends, were cast aside in favor of potential market share and user growth. The prevailing mentality was get big fast, with the belief that rapid expansion would secure a dominant market position. Companies focused on acquiring customers at any cost, believing that profitability would follow once they achieved market dominance, often neglecting sustainable business practices. This strategy, while seemingly sound in theory, often led to unsustainable burn rates and ultimately contributed to the bubble's demise, leaving many companies in financial ruin. In the heady days of the dot-com boom, a new metric for valuing companies emerged: eyeballs. The number of website visitors, or eyeballs, a company could attract became a key indicator of its potential worth. This metric, however, proved to be deeply flawed. While a large user base could potentially be monetized in the future, it was not a guarantee of profitability. Many companies with impressive website traffic struggled to convert visitors into paying customers. The emphasis on eyeballs over profits created a distorted sense of value, inflating the bubble and setting the stage for its inevitable burst. Section 4: Irrational Exuberance, Market Psychology, and the Dot-Com Bubble. The dot-com bubble was fueled by a potent cocktail of factors, but at its core was a phenomenon known as irrational exuberance. This term, coined by economist Robert Shiller, describes a period of excessive optimism and speculative investment that drives asset prices far beyond their intrinsic value. Investors, caught up in the hype and fear of missing out, disregarded traditional investment principles and poured money into internet companies with little regard for their underlying fundamentals. This herd mentality created a self-reinforcing cycle, driving prices ever higher until the bubble finally burst. Section 5: Lessons Learned and Echoes in the Present. The dot-com bubble serves as a cautionary tale about the dangers of unchecked speculation and the importance of sound business fundamentals. It highlighted how critical it is to have a solid foundation in business practices. While the bust was painful for many, it also served as a necessary correction, clearing out unsustainable business models and speculative ventures that had no real value, and paving the way for the next generation of internet companies. These new companies were built on more robust and sustainable business models. The lessons of the dot-com bubble remain relevant today, particularly in the context of emerging technologies like cryptocurrency and artificial intelligence. These fields are rapidly evolving and attracting significant investment. While these technologies hold immense promise, it is crucial to approach investments with a healthy dose of skepticism and a keen eye on the underlying fundamentals. Investors must ensure that these new ventures have a solid business plan and real potential for profitability. The dot-com bubble reminds us that not all that glitters is gold, and that even in the midst of a technological revolution, sound business principles still apply. These principles are timeless and essential for long-term success.